Hi, this is Doug English with Act Advisors with your January 2023 update. Well, we have 2022 behind us. And we're glad to see it so. It was a very difficult year for both stock and bond market investors, with the S&P dropping around 18% for the year and a historical drop in the bond markets of about 13% for the year. So that means there was really no place to hide except cash for return last year. But boy, have things changed. Interest rates are much higher now. The Fed is starting to slow down now. And the historical pattern is really compelling. When you're past a midterm election, every 12-month period of time in history has positive stock market returns. And when you have a Fed slowing down their rate of increase, it seems like a very good opportunity for bonds, particularly municipal bonds, and we have your portfolio positioned appropriately for both of those opportunities. So with that, talking about December, in December, the stock market decreased about 5% for the month. The bond market was just about flat, depending on what kind of bond you were in. So going into January, we have our stock and our bond rotation. They are a portion of your accounts. They are not the majority of the account, but they are the portion of the account that changes every single month, or it could change every month, that is. So the stock rotation is currently invested in mid-cap stocks. They did dramatically better than the broad market in December, and they're going to stay in place for January. In the bond rotation, 2/3 of that rotation was in cash for December, and 1/3 was in municipal bonds. We're taking the remainder of the cash that was just sitting there in December, and it's going into bonds into two additional positions. The two additional positions are convertible bonds and high yield bonds. So all of the cash that was allocated to the bond rotation is now at work in your portfolio. We're very excited about the potential for bonds in 2023, and all of your stock rotation money is also at work. The stocks look quite good this year as well. Now, that doesn't mean the journey might not be very bumpy. There's lots of things to worry about. The Fed's policy is still not clear as to what rate they're going to change things at, but we're really quite excited about the opportunity for you to earn money, to make money in your account in 23, and think it actually looks quite good. Recently, some legislation has passed called the Secure Act that has substantial implications for our clientele. So we're going to do an Outlook event on January 31st online, and you are invited. You'll get an email about it. In that event, we're going to talk about what we think is going to happen in the markets this year and then what we plan to do about it, as well as the Secure Act and how those of you that are not yet age 72 now get to wait to 73 or even 75 before you have to start required minimum distributions. Those of you that are still contributing to retirement plans are likely to be able to contribute more under the provisions of the Secure Act. So look for an email following on that shortly. Thank you very much for your business, for putting up with the difficult markets in 22. We believe good news is ahead for 23. Thanks very much.